Hello, viewers. This is Scott, and I'm going to give you my second quarter review and analysis of the S&P 500. This is mainly intended for TSP participants. Uh, those of you who are TSP participants, the S&P 500 is the index that the C fund follows. You're welcome to um, review this if you invest elsewhere besides TSP. Whether it be an IRA account or even a taxable brokerage account like through Ameritrade or Robinhood or whatever broker you might use. It might give you some helpful info on where you might want to focus your attention or give you an idea of what I think of what's going on with stocks and bonds. All right, I hope you enjoy. I'm going to break this presentation down into two halves. The first half will be the part that will be of more general interest to everybody, including TSP participants. The second half will be info that probably won't interest TSP participants as much as it will those of you who have IRA accounts and uh, taxable brokerage accounts and who wish to invest in sector or index ETFs or in individual companies. But these are the areas that I'm going to cover for those of you who, for the general population. All right, this is the slide that should be of utmost interest to all of you. The bottom row here, the 2018 second quarter, is the most recently reported quarter. There's 500 companies in the S&P 500, of which 5 of them have two share classes, both of which are in the index. They're The purpose of this table here is to identify just how well the index performed in terms of percentage growth over from one quarter to or in terms of one quarter's performance versus the same quarter the previous year, and also what percentage of the companies in the index reported positive earnings growth over that comparison period. Down here in the bottom row, you have 504 accounted for. They reported a total of plus 27% earnings growth, which is huge. You can compare that number against all of the previous quarters that I have on record to the top, and you'll see the second half of 2015 started out weekly positive and then eventually turned to slightly negative, and it's grown steadily since for the most part. Also, positive breadth is very strong. 86% of the companies reported positive earnings growth, or 433 out of the 505 symbols. That's extremely positively strong. Even a 70% ratio of companies reporting positive is very good. As you see, we had about 70% for about 4 consecutive quarters before this most recent one. This is a very, very positive sign for the economy and for stock prices. This one is maybe a little more interest to those of you who invest outside TSP, but it's still good information because what we're looking for is what kind of positive breadth do we have. We don't want to see things like the tech crash or the dot-com crash or whatever you want to call it that happened in 1999 to 2001, I believe. During that period, had stock prices index-wide were going up, but only a few companies were allegedly really supporting it with their earnings. In this case, what we have is 10 out of the 11 sectors are all reporting better than expected results. The expected change here is what I was anticipating from getting as results from each of the sectors prior to the quarter start. The actual change is what they actually did report at the end of the quarter, and as you see, the difference column in the green and red identifies just how much each of the sectors beat or missed on their expectations. Telecom was a very small sector. It's the only one that was in the negative, and I would have to take a closer look at it at the more micro level to figure out why that happened. Okay, in this table, the highlighted area here, current value. That's what I call I think the S&P 500 is worth based only on trailing earnings, where we don't consider future growth expectations at the least bit. The index is currently trading right around the 2,700 level, but with zero growth expectation at all, I would put it about 25.35 to 25.65 for now. This part of the table shows the future values, or where I think as I call it, the zero growth value of the index or the S&P 500 would be over the next 3, 6, 9, and 12-month periods. So basically, by the end of September, I think it's zero growth rate value will be 2660 to 2690. By the end of 2018, it should be up to 2820 to 2845. By the end of March 2019, I'm looking for 2930 to 2960, and by this time next year, I'm looking at 2975 to 3005. Okay, this part of the table, if you're a buy and hold investor, which most of you should be, this part you can ignore. This trading range part it was designed more for swing traders, which is what my own preferred strategy is. If you're a buy and holder, you have nothing to be concerned about. I say the index is valued around half of basically the current value, about halfway between the current value and the 12-month out value. So as we see, about a 440 point increase in that ballpark for between current value and what I expect next year. So if we go up about 200 points or 220, that would put us around 2785, 2775, 2800 ish. That's where I think the index can be reasonably trading short term. But with expectations of more growth over the next year, expect that to climb over the coming quarters. If you're a swing trader, I use the upper and normal lower range as my typical trading range. I don't normally see much in the medium range. I call this the volatility ranges. First one here it's a minus 4% drop. Medium is an 8, and then high volatility is a 12% drop. Generally, we usually only see about a 3 to 5% drop on a normal fallback. During higher volatility periods where you'll have a black swan event and correction, you usually see it drop in somewhere around that 12% range. So if we see black swan events, that's where I'd be looking at trying to get back in if I were already out. But under normal circumstances, I would not let the index drop any lower than maybe the 2690 level at the moment before I'm already wanting to get back in. Any kind of buyback that is at a lower price than what you exited at is still going to be a win for you as far as how you're going to perform relative to the index. All right, this area that's highlighted is just a kind of estimate of how fast basically the 12-month total earnings should grow over the next 4 quarters. So as of right now, in the next quarter ahead, I'm looking at earnings to grow, the 12-month value to grow by just under 5%. 6 months from now, or the end of the 2018 calendar year, I expect to see it grow up about 11%. By March 2019, I'm looking at almost 15.5% growth, and by this time next year, should be about a 17% growth, or 17.25%. This part of the table, it only accounts for that one specific quarter and compares it against the same quarter a year before. So on the 27.3 line there, what you're really seeing is a comparison of the 694.41 figure that I have here against the 545. Uh, and in contrast to the projected and the column to the left of it, the projected, the 4.90% is really comparing this 2688 to 2562. So this is how these two areas differ. Uh, quarterly year over year, or as we call it, a year over year growth for a particular quarter is what most investors use to gauge how companies or even broader indexes are performing relative to previously reported earnings. Because of the cyclical nature of corporate earnings, it's not good to compare one quarter to the adjacent quarter. But as you see, we expected very strong growth over the next couple of quarters. Should taper off next year. So I would expect to see share prices slow down, the share price growth slow down some over the next year. But the more short term, we should still see a healthy amount of back end support. Okay, this is a really important one to look at here. This bond yield data or bond yield curve. Most of you aren't going to understand why this is important to us, but I'm not going to go into too much detail on this right now because there is another article that I just recently saw that I am going to post that will also help elaborate on this. But to put this in a nutshell, banks and government, they usually borrow money here on the short end, anywhere between 1 month and 2 year bonds, and they lend it out to borrowers on the long end. What we're looking for here is any signs of inversion of the yield curve, and in particular, the 2 year note and the 10-year note are a common comparison that gets looked at for that. Usually, a recession, every recession since 1960 was preceded by an inversion of this yield curve. When it first inverted, the recession started. It usually starts 9 to 12 months after it first inverts. We are seeing signs of flattening here, but it's still very accommodative as far as allowing banks to leverage their profits by borrowing on that short end so they can add more long-term interest-paying clients on the other end. When it inverts, it gets to the point where it's just no longer cost-effective for banks to borrow more money so they can leverage their profits and actually get more of these long-term borrowers. And when that happens, it's not just consumers buying houses or cars. It can also be businesses trying to invest in their own expansion. When all of us and businesses are no longer able to so easily get their loans that are needed for what we're trying to do, it tends to stall the economy out. And when we see that, we'll start seeing the earnings growth on stocks in general coming down, and these bond yields will continue to go up. At the moment, 3% for the longest one there. It's barely even half what it normally is when we first start in recessions. Okay, in this area, I'm going to talk about a ratio that is often found amusing when I mention it. It's called the Beer ratio. This is a real ratio that is used by professional investors who like diversified distributions to determine how much of their investment capital they should put in stocks and how much to put in bonds. Beer stands for Bond Equity Earnings Ratio. What it does is it compares the expected earnings yield of the S&P 500 versus the 10-year Treasury note rate. As of right now, the S&P 500's expected earnings yield is 17.32%. This is strongly higher than the current yield on the 10-year Treasury note, which is only 2.84%. Because of that, I would recommend having an 85-15 stock versus bond distribution if you're looking for a more economic conditions sensitive for market condition sensitive distribution. As the bond yields come up and stock earnings yields come down, that's going to start biasing more toward bonds. I update that information every single month. So if you look at my pin post on the TSP group, you can always see each month where you might want to focus, have your money distributed if you really want to have money in all 5 funds, or the GFCS and I funds. All right, this is going to be the last slide that might be of any real interest to the TSP only participants. And this one, even at that, is only informational in nature and meant to just educate a little bit, and doesn't have any real impact on how you might invest. Out of the 500 companies in the index, might surprise you to know that on a typical year, about 24 companies get replaced in the index with some other company. You take a look, pause this, and take a closer look at it if you'd like. I mainly put this in here because if you're invested in index ETFs, which is essentially what the TSP funds are, or a whole stock index based fund, you never really have to worry about the fund losing all of its value and never recovering. Long term, because of these kind of changes going on, the index funds like this, like the C fund and S fund and I fund, will always experience positive share price growth over the long term. All right, for those of you who are investing outside TSP and other retirement accounts that are exclusive, that exclusively follow stock and bond index funds, these are the following areas I'm going to cover. I'm not going to cover anything about any individual companies with this. This is only meant to give you an idea of earnings momentum and what you might expect from companies that might be part of a particular sector or an industry. Go ahead and pause this if you want to read through what this list here is. Otherwise, you're going to see each of these slides anyway. I'm going to have several slides that show you the same exact information, it's just sorted different ways. This particular slide, I'm just showing you how the index breaks down in quantity as far as how each sector breaks down. So the consumer discretionary sector has the most constituents in the index at 80. The information technology sector is second at 72 companies. Financials is third at 71. Industrials is 70, and so on. And you see down at the bottom, you have telecommunications only has 3, materials is 24, and utilities is 29. There are a total of 500 companies, and of which 5 of them have 2 share classes that are both in the index. So that's why you see there's 505 in the total as you're down below. All right, this part of the table, it's sorted by market cap now. This is the same way that the S&P 500 itself is weighted. So you can tell from here that the information technology sector has the strongest weight by almost a 2-to-1 ratio over the financials and healthcare sectors, as well as consumer discretionary. That doesn't mean that information technology stocks will always have this strong a weighting in the index, because if you're not aware, market cap is just a measure of how many common shares are outstanding multiplied by the share price. So if you see tech stocks losing, dropping in share price a lot, but financial sector stocks are increasing in price, what the end result is going to be is that the financial stocks are actually going to have a stronger weight in the index than the IT stocks will. All right, so for this highlighted area covers, sorts them in terms of how each of the sectors performed in year-over-year earnings, or that's basically what they reported this most recently reported quarter versus the same quarter a year ago. As you see, energy just had a phenomenal performance relative to last year, 203% increase. A lot of double-digit gains here. In fact, out of the 11 sectors, 9 of them were double-digit increases in earnings. This is great. Only two sectors, real estate and telecom, had less than double-digit growth, and all 11 sectors had growth. So it's very strong breadth. This highlighted area is the expected change over the next quarter for each of the sectors, or and in other words, what I expect that sector to report this particular quarter coming up from July to September compared to the same quarter in 2017. At the moment, energy is still looking to be very strong, as is materials and infra technology. Go ahead and look through this more. I don't normally look at the future quarter so much as I do the next year. The future quarter is a lot more volatile, and also if you're investing out like in a taxable brokerage account, there are different tax ramifications when you close out a position that you hold for less than a year versus you hold for more than a year. So it's more tax advantageous to hold on to a position for at least a year. So I personally like to look more at the over the next year growth expectation and not so much at what's coming up in the next quarter. But just in case you have a more short-term view, this might help you, or it might not. But you know, that's the risk you take when you play a short-term game too. All right, this is the area that is of more interest to me, and it's actually the same thing I look at primarily when I'm screening for stocks to add to my portfolio. This is what each of the sectors is expected to do over the next 12 months. See, energy is once again the leader here with over 80% expectation of growth. It's very strong. This should be a really good thing for energy stock prices, as well as for energy sector ETFs. So if you're looking for something to add to your portfolio and you don't already have energy stocks in your portfolio right now, is still a good time to add to it if you're looking for earnings momentum kind of strategy. Financials is another strong area. In fact, these are the two areas I just added to my portfolio not in this last year. I added Phillips 66 at the beginning of the year, and I also, which is an energy stock, and then I also added Assurant Insurance within the last quarter, which is an insurance company, and insurance companies are part of the financial sector. I'll cover more of that later, with each of these sectors, because I'm going to break these sectors down into like sector industry groups as well in future slides. This area just shows what the current dividend and dividend yield is, or approximately, for each of the sectors, as well as for the entire index. 1.38% is a little bit on the low side, and I suspect that that's not a very accurate yield for the broader index. Usually it pays about 2 to 2.5%, and for a particular company stock, 2 to 3% when you're buying in is actually a very reasonable yield. Anything higher, I would start worrying about if the share price is dropping and causing it to have a higher yield. And if the share price is dropping, there's a lot of research I'd be looking at. What's going on with their earnings, or is there something else going on that is affecting the company negatively? On the other hand, if the dividend yield is too low, that could also be a sign that they might actually increase the dividend payment, or it could also be that the share price got inflated too much relative to earnings and what their dividend is. I'm not going to go in real heavy into dividend information here, but this is just good, hopefully good gee-whiz information for some of you who might have an interest in that. Okay, this information here shows how each of the sectors did in terms of what I call positive breadth or earnings health this most recent quarter. It's a comparison of just the quarter that was just reported versus the same quarter last year. Very, very positive results here. All 11 sectors have reported at least 2 out of every 3 companies in their sector reporting positive earnings growth. That's tremendously positive. Um, very good, very good sign for very good thing for stock prices when you see this kind of stuff. This slide here is virtually the same as the one you just saw, but instead of looking at the quarter we just completed, it's looking at the quarter ahead. So uh, for the July to September quarter, this is what I expect to see from all of the sectors. We'll see at the end of September how they really fare compared to this. All right, the remainder of these slides are going to break down each of the sectors into their industry groups. I'm not going to go too heavy into any of these. Just please use your pause button if you really want to scrutinize these a little bit more. Down here in the bottom right corner, this tells you about what the sector as a whole is expecting to do over the next year for earnings growth. So if you're looking at sector ETFs, possibly you might get that kind of same return out of it. If you're looking at industries, look in the same column at the respective industry, though. Of course, in the consumer discretionary sector specifically, looks like retail and media are expected to have the strongest performances, while automobiles and components are expected to be weak. For the consumer staples sector, there are three industry groups you can work with here. As a whole sector, it's just barely 10% growth expectation. All 3 industries are in the same ballpark, although food, beverage, and tobacco appears to be the stronger one to look at right now. All right, the energy sector is a simple sector as far as how many industry groups it breaks down into. It's just these 2 groups. Sector-wide, we're expecting about 84% earnings growth over the next year, which leads all other sectors, of course. Doesn't matter which of these 2 industries you might have an interest in focusing on. Either way, you should see good results. The financials sector breaks down into 4 industry groups. There aren't any mortgage REITs in the index though at the moment, so you really just have banks, diversified financials, and insurance. Sector-wide, expecting 25% growth over the next year. That's actually pretty good. Insurance currently leads that with expectations, but any of these industry groups should be worth investing in. Here, the healthcare sector has just 2 groups in it. Sector-wide, it's 13% growth expectation over the next year. Both industry groups are very similar in what their expectations are. So, if you're looking at healthcare stocks, anything in the sector is worth at least looking at. Industrial sector, I have three industry groups to work with here. About 19.75% growth expected over the whole sector in the next year. Commercial and professional services has the strongest expectation, although transportation is also looking really good. Capital goods, even though it's the laggard here, it has a very healthy expectation over the next year. Transportation stocks are a really good thing to look at as far as gauging what's going on with the broader economy, because anybody who has goods to sell probably needs to have it shipped. So when transportation companies are experiencing increasing freight, that's usually a good sign for the economy. So when you see transportation stocks up 20%, that's another sign of a healthy economy. For the information technology sector, as you know, this is the largest market cap group at the moment. Sector-wide, expect about 13.75% earnings growth over the next year. That's going to be led by software and services companies. Semiconductors are currently the weakest, but all of these sectors may be worth at least looking at. Definitely don't discount this sector. It's of course a very popular one as well. Our material sectors, that's got 5 groups that it breaks down into. Sector-wide, 23.75% growth expectation over the next year. It's led by the metals and mining companies, only 3 of them though. All of them are expecting double-digit growth over the next year. Chemicals might be a little bit on the weak side, but it's still upper teens expectation for the next year. Also, if you're looking at materials, you might want to consider if you have energy sector in your portfolio already, and if you have anything else lacking that you might want to look at as well, because as I believe I might have mentioned earlier, energy and material sector stocks all tend to be sensitive in the same direction with crude oil prices. So if crude oil prices are moving up, then energy and material sector stocks are both likely to do the same thing. You don't want to weight your portfolio too strongly with stocks that are sensitive to the same influences. Utility sector is what we would consider a safe or a little more recession-proof sector. So if you want something safe to invest in, this might be a good area. Not expecting much right now, but that's also a good thing, because if everybody's expecting stronger growth in utilities, then that's a sign of a good economy. Only 2% expectation index sector-wide at the moment, with most of that coming from the multi-utilities companies. The telecom sector is another one of these safe sectors as far as recessions are concerned. Doesn't mean that they're not going to lose value during recessions, but they tend to lose less value than the more cyclical sectors. Telecom is expecting 7% growth over the next year. Although these 2 industries, I'm going to have to do some research into why my 12-month forward expectations for them individually is about twice what I'm expecting for this sector. There's obviously something wrong with my calculations there. REITs are looking pretty weak right now. There's 2 groups. All but one of them are what you call equity REITs. This is another one where I have some flaws with my formulas that do these calculations for me. Sector-wide, it's saying about 6.9% growth expectation, but as I look over to the left here at the trailing and forward numbers, that's a decline, not an incline, or contraction. That's not expansion. And when the equity REITs are all but one and expecting almost 11% drop in earnings over the next year, that supports my view on that. Real estate investment companies are generally negatively sensitive to rising interest rate environments, and they react positively to declining interest rates. Right now, we're still in a rising interest rate environment, so that's why the earnings as a whole are going down for this group. There may be some companies in this group that are actually that respond the opposite direction to bond yields. But in general, this is not one I would look at during a rising rate environment. However, keep in mind here that by law, REITs are required to pay out 90% of their profits back to their shareholders and via dividends. So for long-term holding, this is always a good group to look at. So if you want something to help to hold long term, you might still want to consider this group here, and use dollar cost averaging to soak up as many shares as you can on the way down, and as the earnings grow, so the dividends might also. All right, that's all I have for second quarter review and expectations. Uh, I'll give you more at the end of every quarter. Let me know what you think of how this presentation went. What I might have missed or what could be done better, or any questions you might have that I didn't answer that you wouldn't mind getting answers to. Uh, any kind of feedback, you're more than welcome to give, whether it be on the YouTube page or in the TSP group. Thank you.